What's going on, everybody? Michael Silva here. In today's video, we're going to talk about how the Fed is not here to save you. I got some blue arrows and some purple arrows on this screen that we're going to be discussing in detail on a big picture time frame, and then we're going to zoom into the micro time frame. You're watching the Stock Market Brief Show. Like I said, my name is Michael Silva. If you haven't done so already, make sure to hit that thumbs up button. It is greatly appreciated, and subscribe to the channel if you like technical analysis and intermarket analysis. We're going to get right into it. Now, what are the blue arrows and the purple arrows highlighting? They're highlighting on the quarterly chart. Okay, so each candle represents a quarter. And then the purple line is the 5 EMA. The blue represents when we had a quarterly close beneath the 5 EMA. Okay, that's what the blue represents. The purple represents when we had 2 quarterly closes beneath the 5 EMA. Now, I'm highlighting this chart very specifically because every time we've had a quarterly close, yes, every time, boom, 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 ba-boom, ba-boomshki, every single time here on this chart, the Federal Reserve has stepped in. What do I mean? Okay, the first one right over here, right there, this was actually when Bernanke hinted at quantitative 2 and when quantitative easing 2 was actually announced. Over here was Operation Twist. Then we had the China stock market turbulence over here. We had the repo crisis and the Fed pivot, and we had unlimited quantitative easing. The Fed stepped in much later in the process during the dot-com bust, as well as the great financial crisis. It was announced and expanded upon later on. Now, the reason why I'm pointing this out now is because when we have 2 quarterly closes, in the last 20 odd years over here, it led into greater declines. And right now, as it stands, we still have time left in this quarter. Not much. It's September 17th. The month's almost over, which means the quarter's almost over. We're about to close beneath the 5 EMA once again. And if you even take it deeper and you look at these technical indicators, the PPO down here, you can see we're having a bearish crossover. And the last times we had a bearish crossover during the period where we had 2 quarterly closes beneath the 5 EMA, it led to more downside as well. Interesting times. Now, why won't the Fed save you? Well, the Fed is fighting inflation. They're in a quantitative tightening cycle, and they're tightening into a slowdown where it's likely to see more earnings recessions. This is very similar to 2001, 2002 dot-com bust. If you take a look at the quarterly chart zoomed in the great financial crisis, you can see it throws people off very often where we came into bear market territory, right? Bear market territory is this red shaded area. You can see we hit into it and we bounced way up. What kind of emotions does that create when you see price come down 20% and come all the way back up, right? This candle, I'll draw it green. This candle was actually a solid green candle at one point and then completely reversed on itself. What does that remind you of? Reminds me of, well, right now, all right? We saw this big move to the downside coming into bear market territory, came all the way out, and everyone's saying, bottom's in. Well, bottom's up. Look at what happened just within this quarter. A very short period of time, the bears stepped right back up, okay? Pushed the price all the way down, and we still have time left in this quarter, as already stated, but we're right there flirting in bear market territory. We came into it this last week once again, and then we bounced a little bit out of it on Friday's trading session. So we're not out of the water by any means. And I'll tell you exactly in this, like what it is that I'm looking at on a shorter time frame and what it is that I'm currently doing in order to, be tactical in this environment. On August 31st, I posted this tweet. I posted it, let me switch back to blue there, 3714.38. What is that? What people ask, what is that? Well, that was the monthly expected move based off of implied volatility. It's an expected move that I do every month, every quarter, every week, just to get an idea of how the market is handicapping risk looking forward. Implied volatility is extremely important. Historic volatility is extremely important because it allows you to be volatility adjusted in your investment process. Okay? Now, the reason why I pointed out that number is because I wanted people to be aware that, hey, there's still a possibility that we can come down to this range. Now, I will say, off topic, on the weekly time frames, we've been breaking those expected moves left and right, which tells us that there's some inefficiency as far as the market depicting what the risk looks like a week out. Now, as far as a quarter out and a month out, it's been pretty accurate so far. Okay, and if it keeps breaking these weekly, it's going to break something eventually. Okay, because it's not normal for that to have happen, and that's based off of a mathematical formula, right? We're using statistics, standard deviations, etc. Now, if I take a look here at the monthly time frame, that 37 number that I pointed out, we're not too far from it. It's right here. 100 points off. Okay, now we're going to dive into the smaller time frames later, which actually kind of looks like we can get a short-term bounce. But I want to just call out on these monthly time frames, big picture, right? RSI, it's below 50, pointing down. Our PPO, boom. We have wind at our face if you're long. I've been hearing a lot of people try to call bottoms and try to call melt-ups. I just, I'm open to the idea, but I'm not going to go heavy as if I'm incredibly confident that that's going to be the case, right? I can look at this chart right here. I can be like, it's a bull flag. And it's going to break out, and it's going to go like this. Okay, yeah, but the Federal Reserve is pulling liquidity out of the markets, right? They're tightening. And as you can see, when they tighten, boom, to the downside, look at how volatile the market is. It's still heading down, right? And we just recently upped it for quantitative tightening, right? 95 billion. Okay, so this is the early stages. All right, if we continue on at the weekly time frame. Now I want you to call out this little candle, right? We had triple witching, nice little hammer candle. Is this where you want to short? No, that's not where you want to short, not at all. Right, we have a little bit of a positive divergence building here on the MACD, and then we also have this hammer candle right here. All right, so yeah, can we get a bounce? Sure. What's the expected move going into next week? Well, it's to around 4,000, just beneath it, and then as low as 3,750, which really lines up very close to the monthly lower expected move. Now, the weekly expected move this week, it's actually a lot bigger comparatively to the prior weeks. And the prior weeks, we've been having, 2 deviation moves from the weekly move. So yeah, now finally we have a bigger weekly expected move. But these last few weeks, like the last week was like $90. It was plus or minus $90 that it was expecting. And it broke it like by an extra 100, right? So 2 standard deviations. It's a volatile market. So if you're trying to handicap, a specific direction as where you think it's going to go, you got to be careful, especially given the context of what we have been seeing in this market. If I look at the weekly time frame, look at that candle. It's an outside trading candle. Look at how just look at how crazy this is. Look at, so we had price momentum to the downside, okay? Boom. That was a big candle. That was an outside trading candle for the prior week. Now we had even more volatility this week, and it was even bigger, and it's engulfing the prior 2 candles. So, yeah, it's crazy. It's volatile. That's a very bearish looking candle overall. So despite seeing that daily hammer candle where we can get a little bit of a bounce up, we're still beneath the 5 EMA on the weekly time frame, which is right now at 3997. So basically 4,000. And that 4,000 level matches up with what? The 4,000 level matches up with about the weekly expected move. So if we get a bounce, like we've stated is a probability, yeah, we bounce up to the weekly expected move. Does that all of a sudden count as a bottom? It can simply just do that. All right, so in this environment, once again, you need to be incredibly tactical, and there's not much else to it. Like you just need to be, or just sit on your hands, because as it stands right now, it's getting pretty rough out here, and I'll tell you exactly how my portfolio is positioned towards the end. If you take a look at this and you look at the bond market is in a bear market, and it's completely flat on its face right now. Okay, this is on the back of rising yields. Yields continue to press upward. When the yield continues to rise to the upside, that's putting more pressure on growth stocks. Okay, and if you take a look at the yield curve, the 10 and 2, which is down here, right? 10 and 2, it is still completely inverted. That we haven't seen this type of inversion. You have to go back 20 years or something like that. It's minus 40 basis points. The 10-year and 3-month, the Fed staple, quote unquote. It's flat as a pancake. I still think that this is going to invert at some point. And when is that? I don't know, but it is still flat as a pancake. So it's not looking good overall. And then on top of all of that, you have a dollar that has just been an incredible asset to hold on to this year. All right, higher highs, higher lows, and you can see right here, if you pay very close attention, the Bollinger Bands are contracting. They are tightening up, and it's in bullish context. Okay, so yeah, if the dollar comes down slightly, we'll say, boom, just to the lower range to 108, right? You got to really start breaking these levels in the dollar to really think that the dollar has hit a top. Okay, so yeah, the dollar backs off a little bit, boom, like this. What the S&P 500 is going to come up to 4,000? Okay, cool. Maybe higher? Okay, we'll see. But as it stands right now, I mean, you know, what's bullish and what's bearish on my screen? Bearish, S&P 500. Lower highs, lower lows. Bullish, higher highs and higher lows. This is the dollar. Stop trying to fight the chart, okay? Now, next week, we have the FOMC meeting, the press conference, all right? The interest rate decision. We have existing home sales, housing starts, building permits. We got some good data coming out, okay? The big one's going to be the interest rate decision, so let's talk about that really quick. The market is currently pricing in an 82% probability of a 75 basis point hike. There's a small possibility of a 100 basis point hike. Chances are probably going to get the 75 basis point hike. What would be a surprise? Probably the 100 basis point hike. Now, I want to zoom out to the end of the year on December 14th, right? We have the September meeting, we have November, and then we have December. What is the market pricing in right now? There is an 88.4% chance of being between 400 basis points to 475 as far as the current target rate, or the target rate. The current target rate is 225 to 250. Okay, so what does that mean? I drew it up here. So that means this year, the Fed, they ain't going to save you. All right? They are on a path to raise rates. So what does that look like? Well, it would look like this. If we're going to get a 400, right? You know, if we're actually going to end up at 400, this is on the lower end. Like, we're not going to, the probability of getting here, okay? What would that look like? Well, it would look like a 75 basis point hike, then a 50, and then another 50. That would take us to 400 at the end of this year. Now, what if they come out with 100, right? That could be a possibility. Then we'd have to change, see what happens after that point. But as it stands now, the market is the probability of the Fed continuing to raise rates to the end of the year seem high, seem likely. Okay, so tightening is going to continue. Rates going to go up. That is not good for the overall markets. Who knows? Yeah, they're probably going to continue tightening until something breaks, right? Now, if we take a look at the week-to-date performance of the 11 sectors, everything was in the red. When everything's in the red, okay, things could get overextended to the downside. Now, there are a couple of sectors here that, I'm still keeping an eye on very closely. And I highlighted them right here. It's energy and utilities. Very simple, right? They've been in uptrends. They've been doing good for the year. And these are the only two sectors out of the 11 sectors that are standing right above that 50-period moving average. So, when it comes to, me, I wanted to go long because of these overextensions to the downside. On my portfolio, I covered many shorts into Friday. Okay, so I was short Bitcoin. That was great. I used BITI as the ETF. I shorted it and I covered it for about a 14% gain. So that was good. Now, I went long energy and I went long utilities into Friday's close, a little bit before. Okay, midday to close. Now, the reason why is because, like I said, they've been performing year to date strong, and I want some exposure to the long side if we do get a bounce. So I want the ones that are stronger if we get that bounce. Okay, that was my thought process. Now, you might be thinking, okay, well, how much? Well, I am still, at this particular point in time, I am 70% cash, and I have 30% exposure into the markets. Okay, so I have some individual names, and then I have, basically just energy and utilities. All right, and that's only 30% total of my capital, right? So on Friday, while the markets were really down, my portfolio happened to be up 11 basis points. Not much, but it's something. Now, if we take a look at the buy and sell signal, getting a little frothy here on the put to call ratio, right? You can see the purple line right there. It's getting up high, which can mark short-term pivots, obviously, but be mindful that we have all kinds of economic data coming out this next week that can throw anything for the boat, right? Now, I would personally like to see this 10-period moving average cross down below the 0.95 to activate another buy signal. The last times that has happened, which is here, they're all the green highlights, right? You can see that we bounced up, we bounced up, we bounced up, and then we started to fall. It tells you, it doesn't tell you how high it can go, but it tells you when we could see some reversal in the markets or a stronger move in the markets, okay? Now, if we take a look at the heat map week to date, you can clearly see that the big tech is what brought the market down. They got absolutely annihilated. Meta, Google, Amazon, Microsoft, Apple. Microsoft was down almost 8%. Amazon was down almost 8%. Google was down almost 8%. Everything, was a strong correlation to the downside in the market, pretty much across the board. Tesla, on the other hand, managed to stay up. So that chart actually surprisingly looks decent right now. Okay, so when I look at something like the BP chart for technology, this is getting back into overextended to the downside levels. So 29.16. Okay, so is this where you'd consider shorting? That is not where I'd consider shorting. There's a small positive divergence that's currently building. And you can see that right here. We have a low, a lower low. We have a low and a higher low. So a small positive divergence there. And we have some big moves to the downside. It's likely to see some sort of a bounce, right? And these big mega cap stocks, the S&P 500 is cap weighted. It can bring it right back up. All right, if you look at the BP-SPX chart, that's also moving into overextended. So we're overextended. We have a hammer candle that's forming on the daily, right? The expected move is widened. We're disconnected from the 5 EMA. So in short term, it seems like we can potentially bounce. Even if you look at growth versus value, okay? So growth versus value here, kind of curling up. It's still below zero. So I'd like to see a cross up through zero, and that might, bring us where we can see more of a pop in the Qs. And then if you take a look at the summation index, yes, on the greater view of this trend, it is still down. Parabolic SAR, you can see they have the little ticks right here beneath it. So we want to see it click under, and it's below zero. That's not good. However, the market, you can see the Nasdaq Composite, we have a low, a lower low, we have a low, we have a higher low. So small positive divergence building right there too. Okay. So there are various things that are saying to me right now that the market is likely to see some sort of a bounce. I'll clarify what it is that I'm doing momentarily. I want to take a look at the zones. Okay, the zones right now, if you're unfamiliar with these are something that I share on the Patreon group. I also, by the way, if you like my stock market indicators and all these charts, I'm starting to load them all up now on the Patreon group too. There's a link. You can see how it's built. You can look, it's on stock charts, and it goes right to all my charts. Okay, I also include weekly expected moves. I track like 40 products. I give trade ideas of charts that I'm looking at. I give my watch list. Then you get access, obviously, to the community, right, where they have a lounge, memes, intraday trades, swing trades, crypto ideas, and just a bunch of other people sharing their ideas, talking back and forth. And I charge $9 a month. It's by far the most inexpensive thing that you'll probably find out there, because I've seen ones that don't do nearly as much of work that I put in. That's incredibly expensive. And if you think that $9 a month, I personally, I do not like paying monthly for subscriptions. I like just paying it annually, one and done. You get a 16% discount. It ends up being like $7 a month. So $90 US, you can access a year, to all this stuff. Because, okay, so let's continue on. There's the sales pitch. If you go to the zones, S&P 500, the mid range, if you've been watching this show, it's at 3957. Where was it last time I showed this? It was at 3999, basically 4,000. So the middle of the range is going down, okay? If you look at the VIX, look at the low end of the range. It's at 2298. That has been going up, okay? So we have the volatility, the lower range is increasing. We have S&P 500 coming down. So also to pay attention to, where do we close at? 3873. Yeah, if we get look at 3957, we're looking at the upper edge of those weekly expected moves. So we have a lot of confluence over us, right? So as we're looking at a 1.28% downside potential as it stands right now, these are dynamic. They're constantly changing. Upside 5.62%. Okay, and then we have the mid right at about 4,000. Yeah, it just seems to me like this is not where you want to short. If you are short, and we've said this on the last bounce, this is why I re-shorted into the last bounce, and now I covered, okay? It looks like the possibilities for a bounce are there. This is not where I'd be holding shorts, unless if it's some various names. There are some good setups out there, but this is just kind of my thought process, okay? If I look at the 15-minute time frame to get even more, granular, we have subtle divergences that are building that are positive, right? We have RSI, we have a low to a higher low, we have a low to a higher low on the price momentum oscillator, okay? And overall, we have the price action bringing in new lower lows. So it tells us that momentum to the downside could be very well weakening, okay? However, right, if we look at the midpoint, if we look at the weekly expected move, right, the midpoint on the zone was about 395. It was right around here. We have the weekly expected move, upper level right up in here. We have the 5-day moving average right over here. I didn't apply the anchored VWAPs to this specific chart, but we have anchored VWAPs right above us too as well, especially if you just anchor it to the CPI day, which is over here. I believe it was over there. Yeah, I'd have to check. I don't have it in front of me. Okay, so if we get a bounce, okay, I want to just draw this out. Draw it out so you can see. If we just go, wee, boom, like that, it's going to bring in a lot of excitement to the markets. However, I want you to be well aware of where we stand overall, right? We have even a bounce that would be that great. We still have a lot of overhead supply. So we need to wait for this 5-day moving average, right? To come down, do its thing. Maybe price can go boom, 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 and then start getting above, and this can start turning back around. Okay, it's going to be a process. It's not going to just happen over, in a single day. So be prepared for that. We have a volume shelf profile over here that can act like a potential magnet as well. All right, so you can kind of see this as like a, sideways bell curve. Boom. This can pop right up into those areas. All that confluence up in this area tells me, yeah, we can get some sort of a bounce, but then we got to just be very mindful of where we stand in the overall context of things. So let's to conclude the big picture. Big picture, right? As far as trend goes, it's down, right? Big picture, the trend is down, lower highs, lower lows. In the short term, things are overextended, which may create some sort of a bounce. So how do I position myself for this? Well, I want to take advantage of a bounce. However, I don't want to put 100% of my capital working for me. So I have 30%. 30% of my capital working, which means what? Because we have volatility that has increased, right? We have volatility that's increased. I don't need to have 100% of my capital, in the works. I can have 30% doing plenty of work for me. And if I get hit to the downside on the sectors and the indices that I choose, or the sectors that I played in the individual equities, it's not going to affect my portfolio too much. This is what I mean by playing tactical. And if you're an intraday trader, which I trade sometimes intraday too as well, you can be a scalper, right? You can even look into the shorter time frames, 5-minute, 15-minute, whatever the case is, whatever you choose, that works best. All right, everybody, that's all I got for you. Hope it helped out. Silva out.